Hi, I'm Mike Gitlin. Welcome to another episode of our Capital Ideas podcast. We get to know the people behind the portfolios, hear from our portfolio managers and analysts, some of the lessons learned, ideas, their investment edge, and a little more about Capital Group. Today, we have Aline Avzaradel with us. Aline is an equity portfolio manager based in San Francisco, 21 years at Capital Group. We're going to talk about Aline's conviction in dividends and her commitment to fact-based decision-making. Aline, welcome to the show.
Thank you for having me, Mike.
So we have so many associates who have interesting backgrounds, and you are no exception. You grew up in Brazil, and you came to New York for high school.
Yes.
Can you tell us a little bit about that experience and how it shaped who you are today?
Yeah, so I was born in Rio in Brazil, and I moved with my family when I was 14 to Westchester County in New York. And I didn't really speak much English when I moved, and we moved in the winter. It was freezing cold, and there was snow everywhere, and I had never seen snow before. And one of my first memories is walking into this high school gym, and there were these kids playing volleyball, and they looked really good, very serious. The coach was yelling at them, and I'm looking from the side, and the coach pulls me aside and says, "Would you like to join us?" Because she saw that I was looking, I was interested, and at first I says, "Oh, no, I can't join. I don't really play that well." And she said, "No, come join us." And she really insisted, and she really invested in me. She was very encouraging, and I ended up joining the team, and it became my one connection with the kids in that school. And yes, when you move, you learn to appreciate different perspectives, which I think I do, and you learn to be more adaptable and flexible, which I also think I am. But looking back, it's really appreciating how small acts of kindness can really have a big impact in someone's life.
Well, it makes you who you are in certain ways today to be able to do that. That's super impressive. But when you were growing up in Brazil, it was a period of hyperinflation. I think there were times where there was 100% annual inflation rate. And that's sort of a crash course in the difference between real and nominal purchasing power. So tell us how it worked in real life when you were living there, and then we'll get into how it affects your investment style.
Yeah, so I grew up in Brazil in the 1980s through the early 90s. And that was a period where, you're right, we saw annual inflation rates of 100%, and it actually accelerated so that in the early 90s, it got to 1,000%. While I was there were 5 different currencies that were implemented at different points in time, trying to curb the inflation, but nothing worked because the root causes of inflations weren't addressed. So you really needed tight fiscal policy, controlling money supply growth, but nothing worked. And then the Plano Real was implemented in 94, but that was after I left. And that is the currency that Brazil has to this day. And then inflation got under control. But while I was there, every day you would see talks about price increases, and you would see the value of money erode right in front of you in terms of what you could buy.
Like at the store.
Yeah, so you would go to I would go to the supermarket, and that would be the people who worked there would have these price label guns, and you could see them going around putting new prices on a product right away. And you would buy a carton of milk, and there would be stickers one on top of the other. You could literally see how much prices went up before you could buy it. So you have your paycheck, and you would want to rush to the supermarket because the next week, you could buy less with that money. So that's a real life crash course into the difference between real, as you said, and nominal purchasing power.
And do you think that affected how you're an investor?
Yes, totally. So I think it gave me a very big capital preservation instinct. And I'm a big believer in Buffett's number one rule of investing, which is don't lose money. And his number 2 rule is don't forget rule number 1.
Right.
So
two good rules.
Two good rules. And I was an insurance analyst, and so followed Warren Buffett and Berkshire for a long time. And that was, as soon as I read that rule, it resonated with me, and it's part of my process to this day.
So you are a portfolio manager in one of our more income-focused strategies that launched about 40 plus years ago, something like that. Did you ask to be in that strategy, or were you asked?
No, I was asked, but it really does speak to my investment style, and that was evident as an insurance analyst. And yes, and that strategy also came about in response to the high inflationary environment in the U.S., right, in the 70s through the mid 80s. And, at the time, wanting to launch a product where it not only gave people current income to help them pay for current expenses, but also future expenses. So you needed income that grew over time. So with a real emphasis on companies that pay dividends that grew over time, because fixed income alone with fixed coupons weren't enough to protect your real income.
So stylistically, it also just matched the way in which you think about managing assets.
Yes.
You talked about being an insurance analyst. You did that for 17, 18 years. How was investing in insurance during the global financial crisis? Because for a lot of folks, it's a distant memory.
Yes.
But for the folks who were knee deep in anything that had to do with financials, it was all in and all encompassing. So talk a bit about that experience during that period.
Yes, the experiences are so vivid. It felt like it was yesterday.
Yeah, that's right.
So it was 3 years into my career at Capital. I joined Capital in 2004. And so the market peaked in October of 2007. And it fell more than 55% over 18-month period, about a year and a half.
Yeah.
And it bottomed in March of 2009. And it took 4 years for the market to recover those losses. So it wasn't until early 2013 that the market had recovered the losses. And so the reason I mentioned that is just to put it in perspective. We haven't seen anything like this in the last 15 years. We've had a lot of downturns, but they were much quicker to recover, and they weren't as extreme. So COVID, I think was one of the biggest ones. So the market fell a little over 30% within a few months. But by the end of that year, 2020 had already recovered, right? 2022 was also similar. 1 year, the market was down a little more than 20%. Within a year later, it had recovered. So that kind of magnitude of drop and length of recovery was something really unusual that we haven't seen a lot. And I was an insurance analyst. Financials broadly were down 70%. It was a period of time where you saw major financial institutions run into trouble, go bankrupt, need a bailout. Lehman Brothers, Bear Stearns, IndyMac, Wachovia, AIG. The list is long. And so
70%. I mean, it is amazing. We were all, we were there, we watched it, but even when you just say it, losing 70% of the value for an entire sector is just a remarkable stat. But
so,
go on.
I was at the eye of the storm, right, as an insurance analyst. And so it definitely taught me so many lessons. It put a real emphasis on risk assessment and scenario analysis and ensuring that I stress my assumptions behind making an investment. And it taught me so many lessons, investing lessons that I apply to this day. And it also showed me what a special place Capital is to go through a crisis. And the culture really came through.
And some of those times we've had, other investment professionals on the podcast, and they talk about that moment where something just goes so wrong. Mm-hmm. It happens in investing. Something goes so wrong and you feel as if the world's come to an end because a stock that you talked to people about and owned yourself went down a lot. And, we were chatting beforehand, and a stock that falls 60 or 70% from there can still fall 100% down to zero. Maybe talk about that and a specific experience and how people at Capital Group reacted and how it made you feel as an investor here.
Yes. So I recommended AMBAC, which was a bond insurance company. Yeah. And I see you're drinking your water. You know the story.
There should be something stronger in here with that.
And that was before the financial crisis. So that was before there were any signs of trouble. So AMBAC was a bond insurance company. And so creditors would pay them a fee. They were AAA rated. They would insure the bond, which means they would pay the losses if they were to emerge. Long story short, I ended up recommending that we sell AMBAC after it was down a lot, probably down more than 50%, depending on when different people had purchased the stock. And it was really early in the financial crisis. So that area of the market started falling early. This was late 2007, early 2008 that I made the recommendation. And yes, it was really hard to pick up the phone and call everybody and say, look, the stock is down a lot, but I think it can still fall a lot. But what that did is it taught me valuable lessons, specifically about how credit default swaps worked and mark-to-market losses and the interplay between collateral posting requirements and what that could do and how you settle derivative contracts and the liquidity issues that can cause to a company, which were then instrumental in my decision to recommend that we sell AIG later on, which was the right decision and the big decision. So in a way, the mistake was a blessing in disguise. That was, and it really showed the culture of capital to have so much support, even though I had a stock down so much.
Well, it was also during a period of time where equity and fixed income folks had to speak to each other.
Yes.
I mean, this was that really coming to fruition. Fergus McDonald, Dave Betanzos, Steve Lotwin, those were folks in fixed income who I know you chatted with during those periods. How does that work in practice?
Yeah, so one of the big lessons of that experience was pay attention to the fixed income markets. The fixed income markets smells trouble oftentimes before the equity markets. And so the collaboration that I had, with Fergus, David, Steve really taught me that. And the CDS spreads is a market's perception of default risk of a company. So I pay a lot of attention to what the fixed income markets are saying. And one of the aspects that I look at a company is their capital allocation policy. And so oftentimes I would call my fixed income counterpart, which was Steve Lotwin. We both covered insurance and also consumer. I followed consumer companies, food and beverage, to ask them about, okay, what is the credit agency saying? What does this company need to maintain this credit rating? Is it really important to maintain this credit rating? Because all of this would then dictate how managements would think about capital allocation. How much money do I spend with dividends, buybacks, mergers and acquisitions, investments in the business? So there was a lot of collaboration that happens between equity and fixed income.
Yeah, it's so important all the time, but during those periods of crisis where liquidity is everything,
yes,
it's super critical. Talk a bit about your investment edge. You and all of our investors have a specific edge that makes them differentiated from other investors. What's yours?
Yes, I think my edge is that I'm very fact-based. I don't infer a lot, which means I separate what I know from what I'm assuming. So as investors, we're bombarded with information and events, and we have to analyze a lot of data. And the brain doesn't like uncertainty. And so we naturally infer, which means we draw conclusions, we make assumptions, we try to connect the dots to try to make sense of all the events and the information. And, let's say, for example, we see someone walking down the street and the person bumps into someone else, right? Someone might say, oh, that person is rude. Someone else might say, oh, they weren't looking, and so they tripped and fell. Someone else might say, oh, they must have been in a hurry. So everyone
different perceptions of the same act.
Exactly.
Right.
So the same thing, if we observe two events of a company, different people will interpret it differently. And so I was an economics and math major, and so I think my brain is trained not to automatically assume cause and effect. And so in order to say that, one variable directly impacts the change in another variable, right? You need to prove it, you need to show it, you need to run an experiment, control for all these factors, and then you can assume that. You can't jump to the conclusion. And oftentimes you can have correlation without causation. And so I think what this does is it allows me not to make too many biased inferences, which can lead to investment mistakes. And it also makes me attune to situations where we say, let's say the market is shooting first and asking questions later, where they make an assumption. A lot of companies fall in price, and I see a lot of opportunity because I think the market is inferring something that we just don't have enough information yet.
So you're more scientist than artist.
Yes. Oh, yes.
You're also, in your style, how you manage money, you're a big believer in dividends. And you talk about, and I've seen you write about it, that not all dividends are created equal.
Yes.
What does that mean?
Yes. Well, what it means is I'm a big believer in dividends and high-yielding equities helping provide ballast to a portfolio and going back to capital preservation and defense. And we have seen that over long periods of time, yield can help with lower downside capture. That means the stock will go down less than the market, have lower beta, and lower return volatility. However, not all yield is created equal. You can have what we call the high yield traps, which will be the companies where trading for a high yield, but they're not necessarily defensive, and they can, in fact, contain a lot of risk. And usually the company is stretched, the balance sheet is stretched, and as a result, there is a lot of risk to dividends. So I spend a lot of time trying to assess the dividend paying ability of a company and not automatically assuming that a high yield is attractive or will be defensive. And the second one is it's not just about the yield, but it's about the sustainability of dividend growth. So the bucket of the market, the dividend aristocrats, is really where you can find very attractive risk-adjusted returns, because if a company can grow their dividends through a cycle, including downturns, that means their earnings and cash flows are very resilient, and those companies will be the ones that will prove to give you that capital preservation and defense.
But right now, with market valuations, the highest quintile yielding dividends in the S&P 500 are trading at something like a 30% discount to their traditional market average. Is there an opportunity? I think people are seeing that, and it's done okay from an absolute perspective, but not as much from a relative perspective. What does the next 5 years look like? Where's the opportunity?
Yeah, so I think this is a really interesting time, and we're starting to see a broadening of the market. And we're seeing a broadening of the market where, yes, there are amazing opportunities within the growth area, and we're very excited about those. And within the U.S. market, as you said, we have companies that have strong fundamentals that have really been left behind in this very narrow-driven rally that are trading at very attractive valuations. And we've seen some of them. Tobacco companies have done well. So you have seen some of them already start to do well. And you're also seeing markets outside of the U.S. do well. Year to date, non-U.S. markets are up more than U.S. markets, and you have more yield outside of the U.S. Right now, the S&P 500 is yielding 1.2%, which is the lowest yield since the dot-com bubble, since early 2000. And markets outside of the U.S. offer a lot of very attractive yield opportunities, and it's the highest yielding quintile in some of these markets that are doing the best. So in Europe, for example, the highest yielding quintile is up 40%, driven by financials and utilities.
Yeah, and that gap, the gap between the S&P 500 yield and 10-year treasuries, 10-year, is pretty high.
Yes.
From a historical perspective.
Yes, you have actually less than 10% of the S&P 500 trading above the 10-year yield.
Right. So there is an opportunity in this broadening of the market to think about those stable dividend growers. Yes. And I think that's going to be a theme we see in 26 and 27, 28, in the next few years ahead. Is there U.S. versus non-U.S.? We talked about some of the delta in dividends. Do you find also from a growth perspective, you're finding lots of opportunities outside the U.S.? Even beyond dividends, just the broadening of the global market. I think the U.S. is something like 65% of MSCI All Country World Index, but now we're seeing greater interest in having non-dollar exposure, access to dividends outside the U.S., some interesting things that are happening in India, Japan, Korea. Do you see those same opportunities?
Yeah, no, I definitely think, well, first, we've had this valuation differential for a long time. And in part, a lot of the companies that have done really well, it's because people looked at them and said, well, the growth is okay. Maybe it's not high growth, but the valuation doesn't reflect the fundamentals of the company. And so you've seen massive re-rating opportunity, and I think you still do, because when you compare the ROE or the growth of certain companies outside of the U.S. with equivalents in the U.S., there's still a valuation differential. And what you also see with a weakening of the dollar is that non-U.S. Stocks also have a favorable outlook, especially in emerging markets. And for dividend-paying stocks, a lot of countries have done reforms that made their management teams more interested in returning capital through shareholders. So Japan was an example. Korea now is an example. So we're seeing lots of payout ratio increases and good opportunities to invest in dividends.
And when you look back at Brazil, is Brazil an opportunity for folks? I mean, going back to where you were born?
Yes, I think so. Yeah. Brazil, people always joke, right? Brazil, the population is huge. It's young, lots of mineral resources. So there's really huge potential in Brazil. So yes, I am positive on Brazil, and especially in the face of a falling dollar, the real has appreciated quite a bit. Election coming up. So
lots going on.
Always Brazilian people are optimistic in general. So yes. Optimistic.
Good. All right. I want to get to the office treasure hunt. And Just a reminder for folks who are good enough to come and listen or watch this podcast, we do this just to show what's in someone's office because it's something has to do with their life, has to do with them at Capital Group. It's just an interesting way to connect something that's obviously important to them and what makes them special at Capital Group. And I found this in your office. It's a compass.
Yes.
And I'm going to ask you for our folks who are listening, I'll hand it to you and ask you to describe what you're holding, what it is, and why you have it.
Yes. So this compass was given to me by a summer intern. At the end of the summer, we have at Capital, we have a summer internship program where investment professionals work with a summer intern and help them through the process. So I've been a sponsor of summer interns quite a few times. And so at the end of the summer, someone gave me this compass telling me that they were very thankful for all the help and guidance that I provided. And I have this still because I think it's very, it relates so much to what we do at Capital. So we're all trying to find true north, right? And the compass is not going to tell you exactly where to go, right? It doesn't say turn left, turn right, go straight, right? It's just this magnetic pull pulling you north. And it's the same way at Capital. Our true north is have superior long-term investment results. And we're all trying to get there in different ways, in our own ways. And Capital really allows us to find our own authentic way of achieving that. I've seen people have terrific results with very different portfolios. And along the way, there are going to be tough patches. And for me, it was the global financial crisis. Right. And you're going to have a lot of support and help along the way.
Yeah, that's great. Thank you. Thank you for sharing that. And you talk about Capital Group, and Aline Wilson was one of our first guests on this podcast, and you interviewed with Aline.
Yes.
Talk about that experience of interviewing with Aline and joining Capital Group, and probably leads to why you're still here today. Because Capital Group's different. I mean, we're a different type of asset management company. We have a different process in how we manage assets.
Yes. So I was a second year at Stanford Business School interviewing for Capital, and I didn't have investing experience, but Aline was one of my last interviewers, where I was already here in LA. I had to get a job at Capital, I have to interview with a lot of people. So I had already gone through a lot of interviews.
You were through your 20 or 30 folks before you got to Aline.
Exactly, yes. I interviewed Carl Kawaja, lots of people. So I interviewed with Aline. And at the end of the interview, I said, oh, that was awful. That went so bad. Because he spent the entire time asking me about my background, where I grew up, what I like to do. It was completely unexpected, right? We go into the interview, and I had prepared answers to all the questions. I had my stock pitch. Why do you want to do investing? Why do you want to work at Capital? I had it all memorized.
Aline wasn't going to spend any time on that.
He asked me none of that. Right. And it felt like a therapy session. And at the end of the interview, I said, wait, what did I say? What did I do? What did I say again?
That's classic.
And I was so sad at the end. And then someone called me to say, you have got a job at Capital and you'll be joining this group. And Aline Wilson was the research director of that group. And Aline Wilson is the research director. So he'll call you to tell you a little bit more about it. And I said, Aline Wilson? Was that the person that was asking me all those personal questions? So, now being at Capital 20 plus years, I understand, right? Especially if you know Aline, you're really trying to understand what drives you, who you are as a person. Right. And he also told me, he said, look, I knew someone after so many interviews, someone asked you about a stock pitch. And if you were meeting me at that stage of the interview, it was because you knew how to give a stock pitch. And that's not what I was interested in finding out.
Yeah, the EQ quotient, the emotional quotient, is so important. And Aline focuses a lot on that.
Yes.
The content, yes, and the person. And I think that's so important. All right, I'm going to make you pick one or two mentors of those thousands of folks at Capital Group. You got to pick one or two mentors.
Yes. Well, so the one that I've had so many, but Darcy Kopshow is one that comes to mind. She was a phenomenal investor at Capital a long time. She retired in 2017.
She was also a member of our Capital Group Management Committee before she retired.
Yes. So she was a mentor not only as an equity income investor. She had this clarity in terms of verbalizing what is a stock that is appropriate for this fund, and also putting our shareholders' needs in perspective. This is a stock where someone is going to need the dividends to pay for their mortgage. And years after she retired, I would still think, what would Darcy say? This stock appropriate for this fund?
Yeah.
She was very clear. And as a communicator, she was able to deliver really tough messages, but in a non-judgmental, non-critical way. And when she spoke, people listened.
Yeah, Darcy's remarkable. I get to see her now and again, and she always has that smile on her face and always some wisdom to share with us as well.
Yes.
She's fantastic. All right, we're going to finish with what you are grateful for. I'm going to share with you the Obsessively Grateful mug. Thank you
That's
for...
even bigger than on video.
I'm telling you, it's a very large mug.
Okay.
So we like to end this way and just share a moment of gratitude. I'm grateful for you joining us here, by the way. Everything you said, just super interesting, and I'm sure people who listen to it or watch it will take a lot from it. So thank you. And what are you grateful for?
I'm grateful for so many things. Health, number one, family, everyone around me that helps me be able to do this job. My husband, my 3 kids, my parents. But, you mentioned a moment. And, when my 3rd child was born, he stopped breathing. And in the delivery room, I still remember, and doctors came in, took him away. I saw doctors surround him. So long story short, he was fine, but he had to spend a week in the NICU and went through this 3-day cooling process. So it was very stressful.
Yeah.
And oftentimes I look at him playing soccer now or doing something, and it's happened a bunch of times where it tears me up a little bit thinking about that moment. And so I'm really thankful for the doctors at CPMC California in San Francisco that were there and were able to save his life.
Yeah, that's amazing. Well, those folks are heroes, and sometimes we all don't thank them enough. They can change and save lives.
Yeah, every day that happens.
It happens every day. Thank you again for joining us. It was fun to do. I'd like to thank everyone else who came in, and we'll see you again next time. Appreciate it.